Imagine being able to build a $1 million portfolio with just a few smart investment decisions. What if I told you that this could be achieved by investing in a handful of simple, low-cost Vanguard ETFs? Vanguard's reputation as a leader in passive investing and low-fee funds has made it a favorite among savvy investors. Vanguard ETFs, or exchange-traded funds, are some of the most sufficient tools for building wealth. These funds are designed to give investors exposure to a wide variety of assets, such as stocks, bonds, and even international markets. Their low-cost structure, a signature of Vanguard, ensures that you keep more of your return instead of losing them to high management fees. For example, many Vanguard ETFs have an expense ratio as low as 0.03% compared to the industry average of 0.5% to 1%. So why Vanguard? Their investor-first philosophy and commitment to low costs make them a standout choice for anyone curious about long-term investing. But more importantly, ETFs in general provide diversification, spreading your investments across hundreds or even thousands of assets, reducing your overall risk while delivering consistent returns. By using Vanguard ETFs strategically, you can balance growth, stability, and affordability, making them the ideal foundation for building a $1 million portfolio. Reaching $1 million may sound intimidating, but let's break it down. If you start investing just $500 a month consistently, with an average annual return rate of 8%, you could potentially hit the 1 million mark in 30 years. That's the power of disciplined investing in compound interest. Compound interest is your best ally in this journey. It's the process where your return starts generating returns of their own. For instance, if you invest $500 a month for 30 years at an 8% annual return, you'll have invested $180,000 of your own money, but the magic of compounding will turn it into over $1 million. Of course, achieving this requires understanding of your time horizons and risk tolerance. If you're young, you can afford to take more risks by focusing heavily on stock-based ETFs. If you're closer to retirement, you want a balanced allocation that includes bonds to protect your capital. The key is to stay consistent and committed to your plan no matter what the markets do in the short term. To build a $1 million portfolio, choosing the right Vanguard ETFs are crucial. Here are 4 standout options. Vanguard Total Stock Market ETF. VTI gives you exposure to the entire US stock market from small-cap companies to large-cap giants. This makes it a great core holding for long-term investors. Over the past decade, VTI has delivered steady annualized returns thanks to its broad diversification. For instance, in 2021, it returned approximately 25.7%, showcasing its potential growth. Plus, with an expense ratio of 0.03%, you're maximizing every dollar you invest. A Vanguard S&P 500 ETF. If you want to focus on America's 500 largest companies, VU is your go-to ETF. These companies, such as Apple, Microsoft, and Amazon, are market leaders with a track record of innovation and performance. Historically, the S&P 500 has delivered annual returns of about 10%, making it a reliable choice for building long-term wealth. And with the expense ratio of 0.03%, VU is one of the most cost-effective ways to tap into the market's elite. Vanguard FTSE All-World ex-US ETF. For global diversification, VU offers exposure to development and emerging markets outside the US, such as Europe, Asia, and Latin America. The ETF allows you to benefit from the growth of global economies, reducing your dependencies on the US market. For example, emerging markets have historically shown higher growth rates, which can boost your portfolio's returns. Despite its global reach, VU maintains a low expense ratio of just 0.08%. Vanguard Total Bond Market ETF. To balance out the risks of stock-heavy investments, BND provides exposure to the U.S. bond market. Bonds acts as a stabilizer during market downturns, ensuring that your portfolio doesn't lose significant value when stocks decline. For instance, during the 2008 financial crisis, bonds helped investors offset losses from equities. With an expense ratio of 0.035%, BND offers stability at a fraction of the cost. How to allocate your portfolio for $1 million. Aggressive growth. 70% stocks, 30% bonds. This allocation is ideal for younger investors or those who with a high risk tolerance, as it prioritizes maximizing returns over long periods by leveraging the growth potential of the stock market. For example, allocating 70% of your portfolio to the Vanguard Total Stock Market ETF or the Vanguard S&P 500 ETF provides exposure to the top-performing U.S. stocks, which have historically delivered average annual returns of around 10%. The remaining 30% can be invested into the Vanguard Total Bond Market ETF, adding stability and cushioning your portfolio during volatile market periods. This allocation works because it balances the aggressive growth of equities with the relative safety of bonds, allowing investors to benefit from compounding returns while mitigating some risks. Moderate growth. 60% stocks, 40% bonds. As moderate growth portfolio is better suited for investors in their 30s and 40s who are looking for steady growth while reducing risk exposure. Allocating 60% to equities like the VTI or VU captures the majority of the stock market's growth potential, while 40% in bonds like BND provides additional protection against downturns. For instance, during a market correction, the bond bond portion can stabilize the portfolio and reduce losses. This balanced strategy ensures that investors can still achieve significant returns while protecting a portion of their wealth, making it a practical option for those with a mid-term investment horizon. Conservative growth: 50% stocks, 50% bonds. Investors nearing retirement or those with low risk tolerance can benefit from a conservative growth portfolio. Allocating 50% to equities like VTI or VU ensures moderate exposure to stock market growth, while the remaining 50% in bonds or international ETFs like the Vanguard FTSE All-World ex-US ETF adds diversification and reduces risk. This approach prioritizes preserving capital while still allowing for steady growth. For example, during significantly stock market downturns, the bond portion can suffer the losses, ensuring the portfolio remains relatively stable. This allocation is ideal for focused on protecting their principal investments while still achieving modest returns. What is dollar cost averaging? Dollar cost averaging is a proven investment strategy where an investor contributes to a fixed amount of money in the market at regular intervals, regardless of the market's performance. This strategy minimizes the impact of volatility, as investors buy more shares when prices are low and fewer shares when they're high. Why it's effective for building a $1 million portfolio. A DCA helps mitigate the risks of market timing and reduces emotional decision-making, allowing investors to stay consistent in their contributions. For example, if an investor commits to investing $500 every month into a Vanguard ETF like VTI, they steadily build wealth over time. When prices dip, they acquire more shares, and when prices rise, the value of their holdings increase. This compounding effect is particularly effective over long-term horizons, smoothing out the impact of market fluctuations and helping investors stay disciplined on their journey to $1 million. Tax-advantaged accounts like Roth IRAs and 401ks are essential tools for minimizing taxes and minimizing the growth of your portfolio. These accounts shelter your investments from taxes on dividends and capital gains, allowing your wealth to compound more efficiently. For example, contributions to Roth IRA are made after tax-free dollars, but with the investment grows tax-free, and withdrawals in retirements are also tax-free. This can significantly accelerate your journey to $1 million by reducing tax drag. Vanguard ETFs are particularly tax efficient due to their low turnover rates, meaning fewer taxable events such as capital gains distributions. Holding funds like VTI or VU in a Roth IRA or a traditional 401k ensures that your investment grows with minimal tax implications. For instance, if you invest $6,000 annually into a Roth IRA with VTI, the growth over decades can be entirely shielded from taxes, allowing you to reinvest these savings and achieve your financial goals faster. Rebalancing your portfolio ensures that your asset allocation remains consistent with your financial goals. Over time, the performance of stocks and bonds will vary, causing your portfolio to drift from its original allocation. For example, if you started with a 70-30 stock-to-bond ratio, a prolonged bull market could increase the stock portion to 80%, exposing you to more risk than intended. By selling some equities and reinvesting in bonds, you can realign your portfolio and maintain your desired risk level. Life circumstances such as approaching retirement, changing financial goals, or shifts in income require adjustments to your portfolio. For example, as you near retirement, shifting from an aggressive growth strategy to a conservative one can protect your accumulated wealth while still providing some growth potential. Using tools like Vanguard's online platform and third-party investment apps can help you monitor your portfolio's performance and track progress towards your $1 million goal. Regularly reviewing your accounts ensures that you stay on track and can make necessary adjustments to your contributions or asset allocation to align with your timeline and objectives. Consistent tracking also helps maintain discipline and reinforces the importance of sticking to your long-term investment strategy. Now that you've learned the strategies to build a $1 million portfolio with Vanguard ETFs, it's time to take action. The earlier you start investing, the more time your money has to grow through the power of compounding. Don't wait. Set your financial goals, open an investment account, and begin your journey today. Which Vanguard ETFs are you most interested in? Are you leaning toward VTI for broad market exposure, VU for S&P 500 stability, or perhaps a mix of both? Share your thoughts and preferences in the comments below. I'd love to hear your take.